alternate questions between the conference room and the calls, but if we have things that stay on topic, we like to try to keep it that way too. Other than that, that's all I have. So, Lynn, go right ahead.
Thank you, Allison, and thank you everyone for attending the webinar, Director's Cut, and also those who've logged in on the internet. It's always great to chat with you once a month. We're talking about July of 2017 production, so I always want to remind people that we're a couple of months behind the current date. So when we're sitting here on a very cool fall day, we're looking back at the hot, dry weather of July and what took place in the oil and gas industry then. And that's just the big issue of all those wells and collecting all that data and getting it together and then getting it to us. But for the most part, good news. I wouldn't say it's great news, but good news in this month's Director's Cut. Oil production up 15,000 barrels a day, 1.4%, and gas production up about the same percentage, which equates to about 25 million cubic feet a day. So both oil and gas production up, not huge jumps, but very positive. We're running somewhere in the 5% above state oil production projections for the state revenue forecast, so that really helps. That will somewhat offset the price, which is the one bit of not yet really good news here, and that is that I think we're still running about 9% below price projections. So somewhat offset by production volumes, but not entirely. Price was really weak at the beginning of this biennium, June and July. Got a little bit better in August, and now in September we're seeing some serious improvement in terms of oil prices. And I included a couple graphs there because I want to talk about the effect of the hurricanes and also the fact that it appears like we're headed for a soft landing on prices, and that's what I think everybody would like, as opposed to a sudden spike in price or a drop in price. On page 2 of the Director's Cut, I included a U.S. crude oil stocks graph that I get from the EIA on a weekly basis, and you can see that for years now we had been running far, far above normal storage volumes around the world and in the United States. We're back into the normal envelope and certainly headed towards average or below average by the end of this year. And so there's the anticipation that we're going to see some significant but not spiky kind of price increase fourth quarter of 2017, first quarter of 2018. We should see that to start happening. So you already see West Texas Intermediate is very close to that $50 number, which is a magic number for us because you've seen that the non-completed wells have just resisted. That number just has not come down. And part of that is the oil price. The other part has been that it was difficult to hire personnel for frac crews, but we've seen that change too. July and August numbers, based on the information I collect, show that we got to 24 or 25 frac crews in July and August. So that should be enough personnel to keep up with our current rig count. That non-completed well count then shouldn't grow anymore. In fact, we should begin to reduce that number if rig count stays in the low 50s to mid 50s. What you see then is that the expectation is that oil prices will get above $50 a barrel by the end of this year, and that we should be tracking with North Dakota's revenue projections by the middle of next year, and that'll be a big positive for oil production and for price next year. In the graph, you can also see the effect of the hurricanes. 2 straight weeks where we broke the trend and oil storage spiked upwards. And that's just because all those refineries on the Texas Gulf Coast were shut down. So production continued everywhere except in the Eagle Ford, and that oil went into storage. But that's a very temporary phenomenon. As you can see in the lower graph, we're actually consuming a little bit more oil than we're producing worldwide. And so inventories worldwide are coming down. And that in the long term will mean stronger oil prices. I think it's going to be a tricky balancing act for OPEC They're meeting again in November. They're talking about production cut extensions. Everybody's leaning towards extending them to the middle of next year. And I think if they do that, they should be able to bring production and demand into balance, and we should see a nice gradual price increase as opposed to some type of a crash or a spike. So that's good information as oil companies start to build their budgets for next year, for them to be looking at those kind of numbers. So those are all positives. Rig count, pretty stable, just not much happening there. Weather was very good. It's always a little bit windy in North Dakota, but the weather didn't seem to really interfere with industry activity at all. One number that we're struggling to track very well is completions. I reported last month that our June completions were, I think, in the 60s, and actually when the final numbers came in, it was almost 90. So that drives a production increase, and we're having a hard time. That data is noisy, and I think that's because of the new frac crews and the increasing number of frac crews. The data is just a little messy coming in, and it doesn't come in nice and neat, so it's a little hard to track. So we'll kind of focus on that. Pipeline capacity, and Justin will talk about that, seems to be doing just fine. Even though gas production was up, the gas capture percentage stayed at 88%. We are seeing one important gathering project come online this month. So one of the two big right-of-ways that the BIA was holding up, that project is underway and should be coming on this month. But then it's going to lead to that gas plant expansion that we talked about, which doesn't happen until the second quarter of next year. So it's going to be a bit of a race or a tug-of-war to keep that gas capture at that 88% number where we need to land by the 1st of November of next year. On the federal rule front, there's a lot of information there. Not much to say, though. Not much is changing. We're in this phase where the federal agencies are shifting between administrations, and the litigation continues. And so, once you get into litigation situations, things just slow down, and it's very hard to mark any kind of progress. But we're continuing to monitor all of that. One thing I don't have in the director's cut that I'll just mention, the Missouri Riverbed Minerals Project is on track. We have signed a contract with a contractor to begin that survey or that review, and they're planning to start work on the 22nd of September up at the Riverdale offices of the Corps of Engineers. So we're excited to get that underway because they've got 6 months to do their review and provide it to the Department of Mineral Resources, and then we've got 90 days to get that out to the public and get public comments and a hearing on that. So things will begin to happen pretty rapidly on that front within a week or so. With that, I will open it up for questions.
None from the webinar yet, so go ahead, Amy.
Why was the gas production, why didn't it increase more? Are some companies restricting gas?
Very good question, and I think the answer to that, I got to repeat the question. Why did the gas production match the oil production in terms of increase this month? Because normally it increases more rapidly. I think there's a couple of factors there. One is that we do have companies that are restricting wells on initial production. One of the things we haven't really talked about is completion technology, and that's changing. The way they frack the wells has been changing a lot over the last year. Companies have discovered that bringing wells on slower and restricting that initial production makes for a better well long term. So we're not seeing the people trying to beat the record for initial production. They're actually thinking about the reservoir and the frac sand that they pumped in, and they're being more cautious with it. So we are seeing companies restrict production. The other thing is that I think we're the rigs have been in the core area long enough now that we're not seeing a shift to higher and higher gas oil ratios. The rigs now for months have been in that core area, and so the two are kind of marching more in lockstep. But the biggest factor would be the way people are bringing the wells on right after completion. They're being much more cautious with their wells when they first bring them on.
Okay, correct. Questions are kind of flying in here.
Okay.
Can you talk about frac crew info? How many do we need to keep output steady? What's the obstacle to getting more?
So on the frac crew business, and I had a good conversation, let's see, was that Tuesday, with Cindy Sanford and Job Service up in Williston. And we discussed that quite a bit and came to the conclusion that 25 frac crews is just about ideal for the current rig count. So with 56 rigs, you need about 25 frac crews to keep up with that. And that will keep the non-completed well count from growing. It'll also result in slow growth, like we saw in production, 10,000 barrels a day to 15,000 barrels a day, month upon month. To see really substantial growth, we're going to have to add 5 or 6 frac crews to that number. And we expect that when we hit that $50 West Texas number, that's going to be the demand, is to add those 5 or 6 frac crews and really start to reduce that 860 non-completed well count. That's the number that will bring a lot of oil production on. That's going to buffer price increases, though, of course, and that's why we think you're going to see a pretty soft landing. If OPEC continues to restrict production and world inventories keep coming down at $50 a barrel, shale operators are going to start to offset that by adding frac crews. We're a small part of the non-completed well count. There's 3,000 in the United States, roughly 3,000, and we've got about a third of that, not quite a third of it. So again, we're at the ideal number for the number of rigs we're at. Once we top that $50 West Texas Intermediate number for 60 to 90 days, then there's going to be the demand for 5 or 6 more frac crews. The impediment really is the competition with the Permian Basin and the Oklahoma Anadarko Basin. The skilled, experienced employees have gone there. And it's been difficult, if not impossible, to get them to move back to North Dakota. So we're in the process of trying to train new people to take those jobs on. And talking with Cindy, there's some real challenges there. Most of the applications that she's getting are folks whose English is not their first language. English is their second language. So we're actually having some discussion about, does the state need some training programs to help those African immigrants and folks for whom English is a second language figure out how to do a computer job application and how to communicate with the other people on the frac crew effectively, so that you got a safe and efficient operation. So real discussion there. I think she said somewhere around 70% of the applicants that she's seeing today for these jobs, English is their second language. So it's a challenge.
If 25 is the ideal number, where are we at right now?
My best count is we're at 24. So we're just about spot on for the current rig count. When we were at 60 rigs, we would have been falling behind. But yeah, we're just about spot on to keep up with the current rig count.
So is 1 million barrels a day the new normal? Can we expect that to last?
It looks like it. Yeah, we had talked in earlier webinars about, oh man, there's a pretty good possibility of dropping below 1 million barrels a day late this year or early next year. But it really looks like the oil price where it's at, the rig count where it is, and the number of frac crews that we can be comfortable will stay above that 1 million barrel a day number. Looks like the new normal, the soft landing.
I guess I just want to follow up on that. How confident are you that it'll get to $50?
The question from in the room here was, how confident am I in the $50 a barrel number? And there's always risks to projecting oil prices, but I would say far above 50-50. I think I'm pretty confident that the OPEC cuts are working, and the price lingering in the 40s for a significant period of time have brought supply and demand into balance. The IEA just recently increased the demand forecast, so actually world demand is higher than the markets had factored in, and the report coming in from OPEC in August is that they had very good discipline on their production cuts. July was not so great, but in August, OPEC really came in at or a little bit below their quotas. So very good discipline. So I have a lot of confidence that by the end of the year or early next year, we'll see sustained $50 oil or a little higher.
Go ahead, Andrew.
The $50 a barrel oil is based off OPEC continuing the cuts. What if they do kind of reverse course and don't extend those production cuts? What would we expect to see?
Yeah, the question was, the $50 a barrel being based on OPEC extending cuts. What if they don't? What if they? Great question. What if they meet in November and say, well, let's just open up again? We would see oil prices probably drop below $40 a barrel short term, and we would have pretty much the opposite of a soft landing. I think we would see an additional slowdown followed by a price spike sometime in the next year or two. One of the concerns that I'm hearing from a lot of the investors and the people that follow oil projections and that sort of thing is that so many very large deep water projects have been postponed or canceled that we're potentially at risk for a price spike 2 or 3 years out. And it's only shale oil that's really buffering that from happening, from the big price dips and the big price spikes. Surprisingly, shale oil is now able to bring a lot of production on very quickly, and then also has figured out how to throttle back and kind of match the market. But if OPEC decided in November to stop reducing production and to go to full production, we would see a significant dip in prices, probably in the $40 range or lower.
You talked about being above that 1 million barrels a day in the state budget. So with the higher than expected production and the offset of the lower price, what are the implications of that?
Well, I think the implications are good for the state from the standpoint that the revenue that we forecast should be coming in. The most difficult thing, and we're going to be having some conversations, I think, next week to take another look back at the revenue forecast and see how we are tracking. I'm anxious to see how the sales tax numbers are looking, because that really is the big general fund driver. And with more rigs than we expected and with more frac crews than we projected, those sales tax numbers should be pretty good. The oil tax numbers weak in June and July, but I think that's going to correct itself when we see the August and September numbers come in. And so it should be a pretty steady, positive revenue forecast going forward.
Do you have any questions? Go ahead.
Do you anticipate that this level of frac crews will continue throughout the winter, or are you hearing that they're going to scale back?
Yeah. Question was, are they planning to continue fracking at this rate through the winter, or do they plan to scale back? And I'm hearing that, if anything, they're planning to try to push it up a little bit. So, yeah, the expectation is that everybody who's working now is going to keep working all the way through the winter, and they would like to add a few more with the expectation that first quarter of next year, we should be seeing oil prices that would drive trying to reduce that non-completed well count.
do we have the equipment in the state for frac crews? Is it just really there aren't enough applicants and?
That's a good question. Yeah, we do have all the equipment we need. You know, just sort of an informal survey of the half a dozen frac operators or frac service providers in the state. They've actually got idled equipment sitting in buildings in mothballs that once they have the experienced people to put it to work, they can add frac spreads pretty easily. They can easily add the 5 or 6.
Did Cindy add any detail as far as where the folks speaking English as a second language are from? You mentioned Africa is one of them. And
that's the majority. The other is Central America and Spanish-speaking people, but the majority of what she's seeing are folks from Africa. They're intelligent people. Their English skills are weak. Their computer skills are weak. It seems like Minneapolis is a common landing spot for African immigrants, and it's close enough to Western North Dakota that they hear about the job fairs and they hear about the jobs in North Dakota and the low unemployment. So that's a great connection, and we really need, as a state, to work on that. It would be awesome if we could turn them into North Dakotans.
So also another opportunity for folks that may have a translating ability.
Yes. Yes. I know nothing about African languages, but Cindy said it's been a real challenge. So, and I think Wilson State College has some ESL classes, but I don't know that they have enough instructors, and that's an interesting thing if somebody has some skills in that area.
Always opportunities to bring off of opportunities.
Oh, yes. Yeah.
Okay. So far, that's it for questions on the webinar. I'll allow for folks to marinate on that and maybe pick one more out if there's not any more questions in the conversation. Go ahead, Dave.
It's just a little bit off topic.
Yeah, go ahead, because there was one that was a little off topic, so I was going to allow it. So
we're going a little off topic.
Okay. They've asked the USGS for a new forecast, or whatever you want, a new estimate of what's out in the Bakken Three Forks. Have you received anything yet?
Good question. So the question from the room here is the meeting and the request that we had with the USGS for a new Bakken assessment. Have we received anything? There have been a lot of conversations going on about those meetings that took place here that day over at Bismarck State College. And there hasn't been a final decision made, but it's trending towards the fact that USGS would prefer to do a full basin assessment in about 2 or 3 years. They kind of had us on their schedule in the 2020 after time frame. It sounded like they were willing in 2020 to come back and do a full basin assessment. In talking with investors and different folks, it sounds like that might be a better approach for North Dakota from the standpoint that what appears to be attracting all the capital to the Permian, on top of the fact that people have a lot of undrilled acreage, is the excitement about multiple shale benches in the Permian. We have that here too. We just haven't advertised anything except the Bakken and Three Forks. So that would offer opportunity for our geological survey folks to do the rock analysis and some of the temperature analysis and that sort of thing to get some of those other unconventional resource benches on their radar. So I think it's trending in that direction, Dave. We don't have a final or official answer yet, but it sounds like everybody is thinking along those lines that would be a bigger positive for North Dakota than and a Bakken Three Forks update right now. So
I forgot this was kind of towards the top of my question list, and I was going to allow it because we were talking about it with the mics unmuted, so it'd be not nice to not share, but the $125 billion investment by oil and gas industry in North Dakota. You talked about that at API, and the Wilson Herald had a story. So do you just want to talk a little bit about that number and what it means for North Dakota?
Yeah, I do. And thanks for asking. So I was asked a couple of weeks ago by one of the rural electric cooperatives, I guess maybe just out of curiosity, or I'm not sure what they were going to use the number for, if I had any kind of an estimate of what the oil industry had invested in North Dakota over the last 10 years. It was a fairly easy number to calculate. We knew what the gas gathering and processing people had invested. We know the cost of Dakota Access Pipeline and the Enbridge expansions. The only thing really missing was tallying up what was invested in drilling and completing of wells. And so I did those numbers. Now, this excludes all the people who built housing and roads and bridges and power lines and that kind of infrastructure. But the oil and gas industry, over the time period from 2007 through middle of this year, invested $125 billion in North Dakota, which is an amazing amount of capital investment when you think about it. It was such a big number that I struggled to wrap my head around it, so I divided it by our average population during that time, and it came out to be $1.8 million for every man, woman, and child living in the state, which is a little bit easier to understand, and also is a pretty stunning number when you think about the investors around the world and the industry being willing to spend that kind of money here in the state. And then it becomes easy to understand what a driving force that was for our economy and our state revenues. So we'll start kind of tracking that number, and maybe we'll do an annual update to see what they've done for us lately.
Okay, and with that, we will switch to Justin Kringstad. Thanks, everybody.
Should be. Always just takes a second.
I'm going to be singing that Janet Jackson song. What have you done for me lately? Anybody? Anybody?
Anybody else?
All right. On that note. Good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. I will get right into some of the regular updates. Again, taking a peek at production around the region. Eastern Montana, South Dakota lagging behind North Dakota in their reporting, but staying fairly steady. As of this morning, there were 0 rigs operating either in Eastern Montana as well as South Dakota, so do not anticipate any growth in the near term from those two regions. We may continue to see slight decreases as we go forward. An update to the overall oil transportation numbers. I did work backwards a little bit, so as I move on to the next slide, those of you who are following this last month, the June numbers, have revised those slightly as well, and you'll see that in the next slide. But for the month of July, roughly 10% continue to move by rail out of the region. The remainder either leaving directly North Dakota by pipeline or being transported north onto the Canadian pipeline networks and being brought back into the U.S. And then we're continuing to see about 8% refined within the region itself. And so this is that historic view. So again, the two that most interest folks are that blue line, which is the pipeline export market share, and then the purple line, which is the rail market share. So June to July, holding fairly steady for the crude by rail, right around that 10% range. Again, things are still very dynamic, still trying to get a better handle on some of those movements and trying to figure out exactly where that number falls. But the consensus seems to be somewhere around that train and a half or so per day. So the numbers that you will see on slide 5, between 100 to 130,000 barrels per day being estimated for the amount of crude by rail leaving the state. And that was fairly steady June to July. If you remember last month, I had it a little bit lower than that for June. However, again, after some additional discussions and research, I propped it up a little bit further than that. As far as the destinations, this is from the EIA, so this is a completely independent look from their office. And so using these numbers, the East Coast
Pad 1, you can see in green, that's continuing to lose market share to the west coast, which is Pad 5 in the purple color on this slide. Going forward, as we start to get the July numbers, the August numbers, September, I'm anticipating we continue to see that shift towards the west coast movements for crude by rail out of North Dakota versus the east coast. Just a quick update at what pricing was doing around the country for the month of June. We are looking at the highest price markets being that Pad 1, followed up by Pad 5. So again, east and west coast having the highest price markets. But again, with the amount of pipeline capacity we have, with the current pricing dynamics within the region, the current market still is pushing barrels to the more traditional pipeline systems, as well as the new Dakota access line reaching the Great Lakes or down to the Gulf Coast. And as we sit this morning, there have been some dynamic changes here over the last number of weeks. One thing you'll quickly notice is the Brent WTI spread. And so if we would have been sitting here several months ago, we would have been looking at maybe a $2 to $3 price difference between the mid-continent Cushing pricing versus the Brent pricing. In the last number of weeks, that spread has widened. We're looking now close to $6 price spread range. When we look historically in North Dakota, if there were barrels that had the flexibility, it seemed to be somewhere between that $4 and $6 range that barrels may start shuffling between pipe or rail options out of the region. And so over the last few weeks with the hurricane impact in the Gulf Coast, with this Brent WTI spread widening, as we start getting into the August and September months, we'll have to watch that very closely to see if we do see any shifts in the way these barrels are being marketed out of North Dakota. Do we see any barrels that have some flexibility to move onto a rail network to take advantage of these price differences, or are they going to continue with the mode of transportation we've seen prior to the hurricane impacting the region? So we'll keep a close eye on that as we go forward. Again, just because of the data lags, it's going to be another couple months before we really have any clarity on that. Truck import exports, fairly steady on the amount of trucking going north into Canada. Imports coming into the state was down slightly. So again, just keeping our eye on this to see how these barrels are impacting the region overall. Moving on to the gas side, a little bit of a shuffle here as well. And so last month, the total flaring percentage, as calculated here, has not changed. It was at 12% June to July. What has changed is where those molecules are being flared. And so we saw a slight increase in the amount of gas flaring from wells that are not connected to a pipeline system, as opposed to the orange piece of this pie, which are wells that are connected but simply don't have enough pipeline capacity. So that is a little bit of a shift that we haven't seen in recent months. When we look historically on slide 11, this is the first time since September of 16 that we've seen an increase in that blue piece of the pie. So again, that the gas being flared from unconnected wells. And just to add a little bit more background or context to that, on slide 12, what we're looking at, this is the metric that I use to track how quickly wells are getting connected to gas gathering systems. And so you'll notice the red line, that's new wells producing gas in North Dakota. The black line is wells getting connected, or new well connections for that month. And so in the month of June, July, new wells producing gas was outpacing the gas gathering. And so that's likely the reason why we saw the shift in the gas being flared growing in that portion of wells that are not connected, because for the last couple months of the reporting, we have seen gas connections lag behind the number of new wells coming online. So this is something, again, we'll keep that in the back of our minds as we go forward to see if the industry is able to catch up in the coming months, or if this is a trend that we need to watch more closely to see from the gas capture side of the world. Natural gas liquids, I'll just quickly touch on this. Another new high for the amount of natural gas liquids being gathered from the various processing plants around the region. Again, you can see now just over 180,000 barrels being produced at the various gas plants. North Dakota as a whole is producing far more natural gas liquids than is represented on this chart. The remainder of them are being placed onto pipeline systems directly in the phase or mixed with the residue gas. So what we're burning in our homes and businesses around the region does contain a significant amount of ethane, a little bit of propane. So we're not seeing those in the numbers. But from just purely the gas plants, we're at a new all-time high for natural gas liquids production, excuse me, from the region. One last thing I will touch on. This was some information that's been coming out from Platts here over the last number of days. This is just some information on Bakken pricing at Clearbrook. And so some of those questions about impacts of the hurricane and what it's doing regionally. We've seen prior to the hurricane, Bakken crude oil pricing at Clearbrook, Minnesota, basically hand in hand, pretty much on par with WTI out of Clearbrook. Since then, it's been climbing now to north of $4 per barrel. The reasoning behind this, Platts has put out some good information, taking a look at refinery demand for a light sweet barrel like the Bakken. During this time period where we had the refineries being hit in the Gulf Coast, there was a shortage, obviously, of gasoline and diesel fuel, and so a barrel like the Bakken runs very well through refineries in order to maximize the yield of gasoline and diesel fuel. And so as a result of that, we have seen an uptick in the pricing for those Bakken barrels as refineries have a desire to run these light sweet barrels to maximize output of those needed refined products. So continue to watch that pricing dynamics as well, but that has been something over the last number of weeks that has been trending upwards. We'll see over the near term, it's likely to stay propped up, but over the coming months as things start to normalize, that Bakken premium out of Clearbrook will likely start to soften a little bit. So with that, I'd be glad to answer any questions.
Do you want to talk about takeaway capacity and just at what point will we see that start to tighten and if we have any running room?
Yes, and so last month, so on my website, if we would go back to the August 11th slide deck, I did include my forecast as well as the takeaway capacities for the region. And in that slide deck, you'll notice that the early to mid 2020s is when we may start to see ourselves become pipeline constrained, again, dependent upon the growth forecast scenario someone assumes. But for the next 5 years or so, we'll likely have adequate pipeline capacity. If growth occurs as I've forecasted, it'll be between the next 5 and 10 years, we will likely be looking at a situation where our production exceeds our pipeline capacity.
Go ahead, Amy.
Do you have any information about whether Dakota access is at full capacity or they're still going to be adding more barrels to the pipeline?
Yep, and so the question was about utilization of these estimates and how Dakota Access fits in there. And so I'm still, in my estimates, using not quite half of capacity, so they're not operating at full capacity in these estimates. So, yeah.
Okay. Good. I don't have any other questions unless you guys do. Okay.
Thank you very much.
Thanks, everyone. Have a good weekend.
Rainy week.